Welcome to Investing Insights. I'm your host, Ivana Hampton. The stock market has cooled on stocks caught up in the whirlwind of artificial intelligence. Fears over whether AI will disrupt a variety of sectors have triggered big sell-offs. Morningstar equity analysts have investigated 132 companies to determine whether that's the case, and they have concluded that AI is not a universal destroyer. The team thinks investors should sort through the wreckage and find newly cheap companies with enduring competitive advantages. Eric Compton is the Director of Equity Research for the technology sector at Morningstar, and he's here to tell you where to look. Welcome back to the podcast, Eric.
It's great to be here.
Can you briefly explain what Moats are and how Morningstar analysts use them to rate companies?
Sure. So, very broad question. I'll give kind of the very high level highlights. But yeah, Moats are a key part of our how we analyze stocks. It affects how we pick winners and losers. It affects how we think about valuation. So Moats fundamentally are we think about none, narrow, and wide. A no moat company is something where we don't have high confidence in the excess returns over their weighted average cost of capital, and so we would categorize those as no moat. Narrow moats are more like 0 to 10 years. We have a high degree of confidence that they'll earn excess returns. And then wide moats would be, not only do we have a high degree of confidence for 0 to 10 years, but we have a pretty good, more likely than not, excess returns for years 10 to 20. So kind of, you can think of it as 2 decades of confidence in excess returns. We define excess returns as a return on invested capital compared to WACC. So you can think about
WACC?
Okay, yeah. So WACC, weighted average cost of capital. So you can think about it as if you've got most companies, you're going to have some version of cost of capital is going to be a combination of your cost of equity. So that's, what sort of returns do equity holders demand? And then if a company has debt, that's where you get the weighted average. So, cost of debt maybe is, debt yielding 6%, maybe your COE is 9, and you just kind of take the weighted averages of those. So that's the hurdle, the return hurdle for the returns you have to hit to meet the obligations of your debt holders plus your equity holders. And then return on invested capital, get a little bit technical, but you can think about that as just the kind of the profits divided by the invested capital, which in this case could be, there's 2 different ways to look at it. One is like kind of a combination of the liability side. So that'd be like the debt plus equity, or you could look at it on the asset side, and that would be things like your working capital, PP&E, intangibles, things like that. But it's basically like companies that have better profits, they're going to earn better returns, often excess returns over their cost of capital. And the companies with competitive advantages will be able to sustain those excess returns for long periods of time. And so in a capitalist economy, there's a lot of competition. If you earn attractive returns, that's going to attract more competition. And so you have to have something special about what you're doing to sustain excess returns. And so if you can identify those companies that can sustain those excess returns, i.e., find the companies with moats, that's going to have a very important valuation impact. You can kind of basically identify the companies they're going to have more sustainable and higher fair values, all else equal.
Got it. Your team reviewed more than 130 companies under coverage that appear at risk to the AI disruption.
Mm-hmm.
Talk about what surprised you in those results.
Yeah, so I went in with not sure like what the outcomes would be, honestly. So I was kind of pretty open-minded. We picked 132 companies that we felt were most at risk from AI. The way we decided which companies to pick for this, it was a combination of factors. Part of it was just a quant screening tool. Part of it was just you do develop some intuitions about which companies are most at risk just by covering those companies. So a combination of those items identified 132 companies that were most likely at risk from AI, and then brought those basically through an expedited Moat committee process where, hey, the analyst, you have to repitch all these companies just to make sure we aren't missing anything and we're making the best calls possible given how fast the technology is changing. Things that surprised me, I wasn't sure. You never know how, I guess, so a couple of things. So one, everyone's got their own views on AI. So you're never really sure where people are on the spectrum of like AI maxi to AI skeptic. So you're never sure how people are going to react to AI risks. You're also never sure how, as an analyst, I would say, it is easy to get dug in on a call, right? So you've been covering a company, you think it's got a moat, now it's down 50%. you're more likely to maybe have some of that hindsight, like anchoring bias and like stick to it. So I wasn't 100% sure, okay, you know, how much are we going to weight maybe some of the new information versus how much are we going to kind of maybe have some more of that anchoring. So I would say I was maybe a little bit surprised by the number of moats we did downgrade. And so out of those 132, we did downgrade 40 companies. Those, if you would have asked me beforehand, if I had to pick a number, it probably would have been below 40. But I think 40 was a healthy number. There was a lot of healthy debate behind the scenes. I think we are trying to do the best job we can to take into account these changing technology paradigms and how it might affect these companies. So overall, yeah, I think it was a healthy process and probably maybe led to a little more change than I would have expected going into it.
Now, we're going to talk about three sectors that Morningstar analysts think that can defend themselves. First up is cybersecurity. Why?
Yeah, so cyber, we actually still really like cyber. We think it's a good space to be in. A couple reasons. So we came up with our own kind of internal framework to think about different vectors that AI will affect companies. A couple of key vectors. One was, we call it like infrastructure versus app layer. And what we mean by that is, AI we think is going to pressure app layer economics. And so you can think about that as if the true value out of your company is really providing like a slick user interface, that's going to be more replicable as AI proliferates. Versus if you're part of the infrastructure layer, and this is where cyber sits, you can think of AI is still going to have to use infrastructure. And so where cyber sits in at the infrastructure is like, I'll give like one example, like Cloudflare, where they like literally are part of the infrastructure of the internet. And so if you want to just even like access websites on the internet, chances are a good percentage of that time you're actually going through like Cloudflare servers. So they're 100% part of the infrastructure, whether you're an AI agent or a human, you're very likely going to be using it. Another aspect of the infrastructure is just cyber protection is part of just the infrastructure of running a business. And so you've got app layer versus infrastructure economics. So we like where cyber sits on that. We also, another thing we thought about, like, does AI increase, neutral, or decrease demand for your product? And so for cyber, 100%, we think it's going to increase demand for cyber protection. Because if you think about AI agents, like a world where you have you're going to have good AI agents doing the things they're supposed to, but you're also going to have nefarious actors using agents to deploy cyber attacks. And so now you have a world where you can automate a lot of this stuff using agents. And so the number of attacks are probably going to go up. The number of vectors upon which they can attack as you get more infrastructure build-outs for agents is also going to go up. And so the number of attacks is really only going to be limited by the amount of compute. And so that's just going to increase demand for cyber services. And so we really like where they sit on the infrastructure layer. We really like the demand dynamics. So yeah, we think cyber is a great place for like AI resistant moats.
What's a top pick from this sector according to Morningstar analysts?
Yeah, so a couple names we still like. I mentioned one, Cloudflare did sell off a little bit. We think they are a little bit undervalued now. CrowdStrike was another one. Actually, both those names we upgraded to wide moat from narrow as part of this process. So maybe that was another thing that surprised me was I think when we initiated this process, it was more about the threat of AI, but we did actually have two companies where we think AI even like boosts them. And so, upgraded those to wide. So we like where those are. Those are probably two of the more undervalued names in the cyberspace. So yeah, I would highlight those two to look at.
Many investors have dumped their software stocks, but Morningstar analysts consider that an overreaction.
Mm-hmm.
Can you talk about why design software looks resilient?
Sure. So design software is another one where, so taking a step back, a lot of these correlations in the market have gone to one. It's kind of like anything within or adjacent to software, like we're just going to sell it all off. Engineering or design software, I think, fits within that, where a lot of those have also gotten sold off. But we think those are going to be a little bit more resilient than just your average like enterprise SaaS app. Reasons for that. So bringing up like a couple other of the vectors we looked at. So one was workflow complexity. So if you think about app layer versus infrastructure, a part of like the app layer, which can make it even more disruptable, is if just it's like more on the simpler side of the spectrum versus if you have a ton of back-end integrations, a lot of domain expertise necessary for building these workflows where there's a lot of complexity. And there can be even like a lot of domain expertise that may not be as easy to pull off or in an LLM. We think that that's going to protect a lot of these workflows. So Workflow complexity was a big component of what we think is going to protect them. Another thing we like about design software is we don't see a lot of obvious demand destruction. We're still going to, depending on which design workflow you're looking at, we're still going to build buildings. We're still going to, if anything, one of the design workflows is for EDA firms, which help design semiconductors chips. So, if anything, we're going to need to design more chips with more specialized use cases. So, if anything, demand will probably go up for those two firms, Synopsys and Cadence. So, yeah, I think a combination of workflow complexity, the demand aspects, and then they weren't some of these firms weren't as subject to seat-based pricing was another one we looked at. There's some elements of that depending on the company, but some of them are also linked to more asset type workflows where you can charge more related to the asset or the usage. EDA firms, a lot of their workflows, they do kind of price on overall usage by the engineers. They've even cited some price increases as they've implemented some AI workflows. So all of those things we think are positive indicators for that space.
What's a top pick here investors should consider?
Yeah, so design. We don't have as many of those that have sold off as much. So not as many of them were as at steep discounts. I think Bentley Systems was maybe one. Dassault was another where they're a little bit cheaper, but we don't see as many of those firms trading at a 40% discount, for example. So we think they're more AI resilient. Something still to look into, but a lot of those firms are maybe a little bit closer to our fair values.
All right. So the third sector is financial infrastructure and data. Why do you think this group would benefit from AI?
Sure. So the financial stuff was actually really interesting because a lot of those firms also, correlations went to one. A lot of those firms did sell off. I think there was a lot of concern about how much of the economics of those firms is just related to maybe less differentiated financial data. And when we look at those firms, that's really a super small part of it for most of these firms. A lot of these firms, there's different ones out there, but if you look at the credit rating agencies, for example, the value that those firms derive from providing credit ratings, it's not because of providing commoditized financial data or the technology behind the rating. It's more about where the ratings sit in the regulatory apparatus and just the network of people in the financial system built around those that use those ratings. And so and we don't think any of that's going to be changed by AI. It wasn't really about how advanced or technologically forward the ratings are. So we don't think AI threatens those. So you're still going to see value for those companies. Credit ratings we think are fine. Some of them are related to payments networks. That was another thing that stood out as a part of this process where network effects was the most resilient moat source. We don't think AI is going to change the power of networks because the power of the network was never about the technology per se. It was about coordinating all the players in that network. So it's financial firms with network effects we really liked. And then, yeah, I think those are kind of two of the main patterns in that. So, I mean, there was a whole bevy of financial firms, like Moody's, S&P, there's a couple others in there too, where they had kind of sold off and we didn't think it was justified.
What's a top cheap pick from this sector?
Yeah, I'd highlight Moody's and S&P were in there in our top picks. Some of the the consumer credit score companies like FICO, that those were in there too. Whereas we just don't really see AI necessarily disrupting that. So those are a couple I'd highlight.
Well, we're at the takeaway portion, Eric. What's the takeaway for investors looking for opportunities within these AI-related sell-offs?
Yeah, I think you got to be selective. So understand that the market's selling off a lot of names, and then you got to pick your spots based on where you think is most resilient. And so exactly what we've been talking about, try to find companies that have sold off but still have network effects, and you think those will probably play out okay over time. Consider some of the cyber names that have sold off, some of the financial firms. Those are things design software, which you already talked about. Those are things I would look at within some of the admittedly like riskier names. So like in enterprise SaaS, for example, we did downgrade a number of those firms. We just think some of the monetization opportunities and some of the switching costs are a little bit more at risk. So we did downgrade a number of enterprise SaaS firms from wide to narrow. But even after doing that, and even after cutting our fair values on a lot of those names, we still see some opportunities. So we think, maybe the market was justified in selling those off a bit, but I think it's probably gone a little bit too far at this point, where when we run scenarios, basically these firms have to go to zero growth like now and probably even see negative growth in the future to justify sort of like the terminal value assumptions that the market's baking in. And so we'll admit those are a little bit higher risk. There are some good reasons why AI could disrupt them, but we don't think you need heroic assumptions for them to still work out. And so you are in this phase where for these enterprise SaaS firms, we think they probably do have a right to win still for the next 12, 24, 36 months. I think owning the customer base, owning the distribution, there's still a lot of value in that. Switching costs haven't gone to zero. It's still not easy to switch out from Salesforce or like your Oracle Cloud Suite. There's still a lot of switching costs there, and the clients, I think, their default preference would be, can the incumbents like basically figure it out and provide AI functionality to us through the stuff we already have? And so we think you have a situation where if these companies can figure it out, they'll probably be fine. And so you don't really need heroic assumptions for these valuations to do better from here. So again, if you're okay with maybe some of the higher risk there, I think there's still some opportunities to look there.
Everyone listening, watching, Eric has dropped a lot of knowledge on us, and there's even more in the research report that you and your team have put together. There's a link in the show notes. Please download it. Eric, thank you for coming to the table and for explaining what is going on within the technology sector.
Yeah, and it's an exciting time to be, I think, in the markets in general and in technology specifically. And yeah, happy to be here and talk about it.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor Morningstar. Take care.